Let's start with state pension funds. You see them going broke in the coming years. Why?
Well, we don't see all of them going broke, but there are several states in our economy that have not repaired their balance sheets since the crisis, and they've been on a morphine drip coming from the feds, and that's really the only way that they've been able to continue to survive. One of the things that's going to cause a crisis within the states over the ensuing years are going to be other post-employment retirement benefits. The states have not been run fiscally sound. They have not been properly funding, not every state, but a good amount of states have not been funding their public pension funds. And that problem is only being exacerbated because of the low interest rate environment. Obviously, pension fund liability is a long-term liability. So how do you manage that as a portfolio manager at the state treasurer's level? You buy long-term bonds, okay? And as long-term interest rates are down here at 2.25%, 3.5% on the treasury side, you can't possibly get the types of returns that you originally budgeted for to make sure that your pension fund would stay properly funded without having increasing amounts of contributions. A lot of these pension funds had assumptions and still have assumptions that they will have 8% returns year after year after year after year in order to make sure that they remain properly funded to fund their liabilities 30, 40 years out. I would love to know some safe, simple investments that I could do and be sure I was going to get 8% year in and year out. We just said that the last 10 years, stock markets returned 0.
Right.
And now we're at a bond market where you're returning 2 to 3%. How are they going to ever meet up with that?
All right.
That's going to be one of the overriding concerns that will have to be dealt with at some point in the near future.
All right, you say we're operating in a new financial market where everything is interconnected globally, but we're using old rules to play the new game. So what are the implications for investors and markets?
Well, one of the things is not having the old roadmaps. You can't sit there and use the stuff that you learned in business school in the 80s and 90s and expect that stuff to help you navigate these uncharted waters. There's been a quote, a new phrase, the new normal of the market environment that we're in. And in this new normal, it's one in which we have much greater tail risk of black swan events that are happening much more rapidly, and you have to manage your money for many unforeseen unintended consequences, and they're going to be only increasing unintended consequences caused by some of these amazing efforts that have had to be put forth by the government in order to stabilize the economy. And nobody truly understands how the complex system of financial markets actually interact. The smartest guys on Wall Street have a very, very good idea about it. They can see around corners. The government definitely doesn't quite understand the intricacies of the complex financial system and the interaction between not just our banks and our Wall Street brokerage firms, but also all the non-banking activities, the shadow banking activities that go on out there, and how they're all interconnected. I use the example of, it's very much like a spider web, okay? Mm-hmm. When a spider builds his web, it looks pretty random to us how he moves around, and it's absolutely not perfect, but the way they do it, it works. And you can pull on some of the strings within a spider web and it'll retain its strength and durability. But if you pull the wrong string, the whole thing can come collapsing down. And without understanding how that web of the complex system of financial markets is integrated, the regulators cannot possibly foresee how pulling on one string can affect the entire web.
Right. So is there a crisis brewing right now that you think regulators are not aware of?
Yes, it's probably twofold. One would be the low rates that we just talked about, okay? The implications to low rates, nobody's ever really studied. Nobody really knows the ramifications of it. We're getting a test case out of Japan, but their economy is completely different than our economy as far as the way they internally are able to fund their debt. The low interest rate environment could be brewing a systemically risky situation should interest rates spike up dramatically in a very short period of time. Right now, the U.S. Treasury's average coupon, if you weighted all of the debt that's outstanding, the average coupon that the Treasury has to pay is about 2.25%. If all of a sudden interest rates went up dramatically and we had 5% interest rate environment and the Treasury had to double their interest expense, it's not budgeted for. When the Congressional Budget Office is doing all the projections, they're using these rosy numbers down here, very, very low interest rates. If all of a sudden interest rates went up dramatically, you would see huge, huge costs to the government to finance that debt. And obviously that would be a budget breaker. The second thing.
Okay, sorry, I think we have to move along because we're running short on time.
Okay.
What's your take on the state of the housing market right now?
Well, I think the housing market, we're probably only in the fourth or fifth inning of a 9-inning game. Everybody would like to think it's settled in here, but it's truly, we still have a lot of inventory that has to be worked out of the system. There's still millions of homes coming into the foreclosure realm. The problem with robo-signing really did nothing more than just put a litigation dike in place to keep mortgages and houses, from going through that foreclosure process, which would clear the system. We really need to rip the Band-Aid off and just let this process happen and let house prices fall to where they need to fall.
And what about home equity lines of credit, these so-called HELOCs, for first or even worse, second mortgages that have gone bad? To what extent are toxic acids still weighing on a lot of the banks?
One of the things about HELOCs, and you don't hear a lot of people talk about it, but there was something in the magnitude of about $1 trillion worth of HELOCs out there that were issued as piggyback loans or just people doing home equity lines of credit, when they had equity in their house. And when these were tapped, the banks did not securitize those away and get them off their balance sheets because they were very juicy instruments. They paid a lot of interest rate to the banks, and so the banks kept them on their balance sheets. However, they're second mortgages, okay? So you cannot restructure a first mortgage. You can't let somebody have a loan modification without wiping out that HELOC. And if you wiped out, let's just say it was $1 trillion worth of HELOCs on banks' balance sheets, the banks do not have the capital to be able to absorb those type of losses. So that's one of the things that's holding back the ability for banks to modify people's loans.
Right, so do you think that the banking sector is actually less healthy than the Fed would have markets believe?
I wouldn't say it's less healthy, but the stress tests that just came out, everybody realized that they were a bit of a farce. We went through stress tests a couple of years ago, and everybody knew they were a farce then. Europe went through stress tests a couple of times. Everybody afterwards knows that they're a farce. The ones we just did were no different. The regulators really want to do is they want to shrink the banks. They want to shrink the bank balance sheets because that way they can get their hands around them. If the banks are not into as many businesses and at huge magnitudes. So they would like to see the banks shrink. The problem with the banks shrinking is that smaller banks equal smaller, lower growth in the economy. Without big, strong, healthy banks, you're not going to have lending, and you're not going to have an economy that can grow from that lending.
Given the extreme amount of quantitative easing that we've been seeing, how concerned are you about the level of inflation in the economy right now?
Well, the level of inflation in the economy right now, as measured by CPI last year, was only about 3.6%. But, you and I who go to the supermarket and put gasoline in our car and have to heat our house and have electricity bills, we all know that inflation is a lot higher than that. One of the things that concerns me is that the same people that are setting or monitoring the inflation rate is the government. And they have a vested interest in keeping the inflation rate low so that the low bond yields don't look as bad when you look at a real, the real interest rate, the interest rate minus the inflation rate. So that is a big concern of mine. With quantitative easing, anytime you print money, anytime you have the printing press going, it's going to be inflationary. And if the Fed thinks that they're so smart that they're going to be able to put the genie back in the bottle or the toothpaste back in the toothpaste tube after printing all that money, that they're going to be able to sop it up, it's never been tried before, it's never been tested. I don't know if they're going to be able to contain all that money that they've created. And that in and of itself would have to be inflationary.
All right, Jim, some noteworthy concerns. We'll go ahead and leave it there. Thanks so much for your insight.
No problem.